We talk a lot about inflation and interest rates, I know, but we're going to do it again today because they help us make sense of the markets right now. Hi, I'm Connie Christian. I'm the manager of fixed income at Wespath. Thank you for joining me for our Markets at a Glance video recapping January. I'll start with inflation. The U.S. Federal Reserve's go-to measure of inflation is core PCE, or Personal Consumption Expenditures Price Index. Core means this measure does not include the cost of food and energy, because those prices tend to be volatile. By excluding food and energy, it's easier to see the underlying inflation trends. As illustrated in our chart of the month, the trend is going in the right direction. In December 2023, the core PCE was up 2.9% from a year ago. This is down from a recent high of 5.6% in February 2022. I want to highlight one other point on the graph. The year-over-year core PCE started with the number 2 in December for the first time since March 2021. This is encouraging for the Fed, which has been working diligently to reduce inflation to its 2% target. The Fed's primary way to combat inflation and bring down the core PCE was to raise interest rates, and raise rates it did, increasing rates 11 times total between 2022 and 2023. However, the Fed has held rates steady since July 2023. Market participants have increasingly come to believe the Fed threaded a delicate needle. It increased rates enough to slow economic growth and lower inflation, but not enough to cause a recession. In response, equities extended their year-end rally. In January, the S&P 500 index of U.S. stocks rose 1.7%. The MSCI ACWI ex-US IMI, an index of non-U.S. stocks, gained 1.3%. The Bloomberg U.S. Aggregate Bond Index dipped 0.3% in January. Inflation and interest rates can also explain the bond market. Stick with me here. The economy remains strong. U.S. real GDP grew at an annual rate of 3.3% in the fourth quarter, according to the advance estimate. It's possible this strong economy could lead to an uptick in prices if demand for goods and services climbs and outpaces supply. Because of this, the Fed is holding off on cutting rates. The markets now expect rate cuts to come later in the year and to not be as severe, which caused yields to move a little higher, and as we always say, when yields go up, prices go down. I would encourage you to check out our monthly investment report for January and learn more about potential market drivers, U.S. economic growth, and how the markets impacted our fund performance.